Investing in America can be risky business, yet millions of people do it every year. The potential to earn large sums of money has led many people to start investing. However, what some people don't realize is that there are many different ways to invest, all with different purposes and outcomes. Because there are so many different types of investments, it takes a responsible investor to know how to invest their money. By the end of this video, we will have gone over some of the different kinds of investments and a little bit about the history behind investing in America. Throughout history, America has greatly relied on investing. In fact, if Ferdinand and Isabella had never invested money into Christopher Columbus's voyages, America may not have been found till hundreds of years later. Investing has also led to many great other discoveries and inventions. Even the greatest minds on earth can't work with their ideas if they don't have the money from investors. As stated earlier, there are many different kinds of investments. The big three that we will be going over in this video is the stock market, bonds, and mutual funds, but some of the others include real estate and art. For example, investing in real estate usually happens in one of three ways. A house may be rented out or sold at a higher price than it is bought. Or the seller of the house may take on a mortgage, just like a bank may, from the potential buyer, with increased interests. Investing in art is very similar. One may buy art from an auction house or an antique store for cheap prices, and later turn around and sell it to collectors. First, the stock market. The stock market is a high-risk, high-potential investment. The first stock exchange in America was the Philadelphia Stock Exchange. However, the New York Stock Exchange was quickly made afterwards and became one of the biggest stock exchanges in the world. As an example, we will be using a sum of $5,000 to invest within the stock exchange. With those $5,000, someone would buy stocks to a company, usually in large amounts. Being a part of the stock market means that one would buy stocks. A stock is a share in a company. To have a share in a company means that you have partial ownership of that company. The risk with the stock market is that there is no guarantee. Companies rise and fall every day. One can invest thousands of dollars into a company that's doing well one week, when the next week they go bankrupt and the investor is left completely broke. If you were to look at a company like Tesla Motors, you would notice that 6 months ago, their stocks were worth $90 a share. If you were to go back and look at their stocks today, you would notice that they were worth almost $140 a share. A change from $90 to $140 over 6 months is a huge increase in the stock market. Buyers that acquired their stocks 6 months ago for $80 can now turn around and sell them for a $60 profit. If the investor had taken all $5,000 and invested them into Tesla Motors, they would be able to acquire about 55 shares including transaction fees. 6 months later, when they sell these shares for $140 apiece, they would be able to make about $7,800. This is over a 50% increase over a 6-month term, which is a huge increase, especially for a short-ish term investment. However, this was a very risky transaction. Tesla Motors could have gotten some bad publicity, and their share values could have gone down just as fast as they did actually go up. The stock market is about being able to watch the companies and predict what kind of publicity and actions they will take in order to predict how their stock values will hold up. Bonds are generally less risky than the stock market. Some bonds, such as government bonds, have a guaranteed return, while other bonds, such as corporate bonds, depend on how well the company does. A bond is like a loan. Take our $5,000 for example. That $5,000 may be invested in a bond that is expected to be paid back within 10 years. On top of the $5,000 paid back, there may be a small interest fee. Next, we will be moving on to mutual funds. Mutual funds are somewhat in the middle of the stock exchange and bonds in terms of riskiness and payoff. Mutual funds are usually made up of a large group of investors that pool together their money to purchase securities. A mutual fund is similar to both the stock market and bonds because investors within the mutual funds can choose where to put their money. For example, with our $5,000, the money may be split between $2,000 and $3,000, with $2,000 of the dollars going into open-ended trades, and the other $3,000 going to exchange-traded funds. The open-ended trades are less risky and more like bonds, while the exchange trades are almost exactly like stocks. Now to recap. Investing can be very rewarding. However, there is almost always a large risk involved. There are either huge amounts of profits or huge losses. It is up to you to become a responsible investor to know when it is worth it to risk your money. This means researching into all the different kinds of investments and finding out which one might be best for you. After you find out what kind of investment you would like to make, look at the trends over the past few years. Do some research. Find out how the investment type might change and what is your best option for making the most amount of money. Remember that by investing, you're not only helping yourself, but you're also helping the global economy. Investing can have a rewarding outcome. Just remember to invest responsibly.